From bad to worse as China's banking system is collapsing. I'm your host, Steve Van Metre, and thanks for joining me today. And Beijing is under full damage control as its financial system is on the verge of collapse as it's being hit from multiple sides. Let's head over to Bloomberg where we picked today's story up. As China to repay more victims next week in biggest banking scam, and customers with up to 100,000 yuan of savings will be paid in hopes that several protests that were erupted since May in the central Henan province will go away. Clients from the four rural banks in central province of Henan, as we've covered in one in Anhui, with deposits of up to 100,000 yuan or 14,800, will be repaid from July 25th, according to local offices of the China Banking and Insurance Regulatory Commission. Authorities began to repay individuals with deposits of below 50,000 yuan last Friday after hundreds of disgruntled bank customers took to the street to ratchet up pressure on the local governments over the past 2 months. And arrangements for those with higher amounts of savings will be subject to further notice, the watchdog said, and this is a clear move to quell this uprising that we covered on the show that threatened to actually spread to more customers and more banks. And you can see that it's under full damage control. And most of the victims were unaware of the illicit activities and never received high interest or subsidies on their savings, the CBIRC told an affiliated paper on Sunday. The regulator had said it won't make repayments for accounts that are suspected to have involved illegal activities or received high interest from other channels. Beijing has started to pare back the implicit government backstop for banks to reduce risky behavior and maintain long-term stability of the financial system. But officials are facing a difficult balancing act if the public loses confidence in the bank's ability to survive on their own or state support in the event of liquidity stress. It could precipitate exactly the type of crisis authorities are trying to prevent, and that crisis is called a bank run, when everyone goes to a bank and starts pulling their money out or perhaps even stops paying on their loans, and next thing you know, the entire Chinese financial system comes crumbling down, and so does the rest of the world. Let's continue on because you can see Chinese banking system being hit from multiple sides. As Bloomberg continues with this headline, is China banks to forfeit 4.6 billion on mortgage break, and city credit risk manageable for most banks as Citigroup estimates, but loan payment boycott may have unintended impact on sentiment. And Chinese banks would forfeit 31 billion yuan or 4.6 billion of interest income from mortgages under a proposal to give homebuyers installed projects a temporary payment holiday, according to Citigroup. Now, you may recall the way it works in China is people actually pay for a home before it's done. So they actually get the mortgage and start making payments, and that money goes to the developer to effectively build out the home. And now, with developers facing bankruptcy and unable to complete homes, many borrowers are saying, hey, I'm not going to pay. And that is, again, number two, the second reason why their system's under threat. The figure amounts to about 1.2% of estimated net profit in the banking system for 2023, assuming 561 billion yuan of home loans would be at risk if Beijing signs off on the plans. Credit risk from the latest round of stress in the property sector is manageable for most banks, analysts estimated. Of course, we've heard that story before. The yet-to-be finalized plan reported by Bloomberg on Monday is targeted at bringing relief to hundreds of thousands of buyers in installed Chinese housing developments. Many have joined a payment boycott that's hit at least 230 projects across 80 cities. The proposed grace period is part of a broader push by the authorities to stabilize the property market, which includes urging local governments and banks to plug some funding gaps for developers. People familiar with the matter have said. And of course, that brings us to the next part as we move forward in this. What's going on with those developers? But one unintended consequence of the mortgage protest could be that consumers become less willing to buy homes, curbing developers' incentives to start new projects. This would then hit municipal revenue from land sales. Of course, the other issue here with developers is they need that money to finish these projects. And without it, well, you can only imagine that they're the big shoe that could drop. As Bloomberg continues now, China's credit market rocked by more debt delays and plunging bonds. Estate-linked South City warns may default without an extension, and Brilliance Auto fails to push through restructuring proposal. China's credit market is now showing stress on almost a daily basis as a worsening property crisis shatters assumptions about safe borrowers, and even Chinese investors turn against troubled debtors. And taken together, the incidents point to a credit market in a new phase of turmoil as stress spreads from cash-starved private developers to those with government backing and companies outside the housing sector. Chinese investors pushing back on debt reprieves or unfavorable restructuring plans also suggest dwindling confidence in Beijing's ability to pull off a fast economic turnaround. And prices of Chinese high-yield dollar notes, a market dominated by developers who are, many of them, facing major financial stress, have neared record lows this week. And while prices of some property notes edged up on Thursday on short covering, the absolute levels remain in distressed territory. And this is bad news, because if these bonds go bust, well, there goes the financial system. The sales have engulfed even investment-grade peers, including China Vanke Inc., another builder, all previously seen as relatively safe. Country Garden Holdings had traded one of its yuan bonds, briefly suspended on Thursday after the security fell a whopping 22%. And China's top-performing mutual fund this year is among a growing list of investors cutting exposure, with major developers like Vanke and seizing holdings dropping out of its top 10 holdings. And of course, that is exactly what happens when prices plunge. Investors run, and then the collapse actually gets even faster. If you're concerned what a Chinese banking system collapse could mean to your portfolio, well, you shouldn't be. I'll put a link up here to Portfolio Shield in the corner and description below, because when financial systems collapse, so do interest rates, and that's what Portfolio Shield hedges on and rally into bonds. Let's continue on, because China is now in full bailout mode as it plans a real estate fund worth up to $44 billion for distressed sector, sources say. And China will launch a real estate fund to help property developers resolve a crippling debt crisis, aiming for a war chest of up to 300 billion yuan or 440 billion in a bid to restore confidence in the industry, according to a state bank official with direct knowledge. A move will mark the first major step by the state to rescue the property sector since the debt troubles became public last year. And the size of the fund would initially be set at 80 billion yuan through support from the central bank, the People's Bank of China, the person who declined to be identified, and you can't blame him. He said state-owned China Construction Bank will also contribute up to 50 billion yuan into the 80 billion fund, but the money will come from the PBOC's relending facility, so this is clearly a government bailout. And you have to understand, if they don't bail out the system and it collapses, not only will it take China's economy down, but it'll take the rest of the world with it, and any confidence that people have in China's economy will be gone, not just for a little while, not for a couple of years, but for a very long time. A key pillar in the world's second largest economy, China's property sector has been lurching from one crisis to another, which is threatening to take the whole thing down, and has been a major drag on growth over the past year. Revolt by homebuyers this month heap more headache for authorities. We don't know the details of the fund yet. If just 80 billion is not enough to solve the problem, according to a chief economist. I believe the fund would be part of the bigger package to solve the current debt and mortgage crisis, because it alone would not solve all the problems. We need a real estate recovery. And so when you have 44 billion that's not big enough to solve a problem, you can tell you how big this problem is. What they need is real estate prices to go up, and as central bankers around the world pull liquidity and tighten financial conditions, it threatens to drag asset prices down even more and cause an outright collapse. And those inside China with a lot of money are starting to see that the writing's on the wall, and they're back to getting their money out, as this headline from Zero Hedge today says China June foreign currency outflows are the second highest since the COVID crash, and its financial system is in danger of disintegration should the housing crash escalate further, which is why a sharp reversal of months of non-action have now led to the Beijing launched multi-billion fund that we just talked about to support struggling developers. Many have been wondering how long the local oligarchs will wait before pulling their money out of the country. Well, according to the most accurate gauge of foreign currency flows, June saw another month of net outflows around $9 billion in comparison to inflows of $2 billion in May, the biggest outflow since February and the second biggest outflow in 2 years, going back to the COVID crash. And you can understand, if they think the system's going to topple, you bet the people that can get their money out want And of course, we can't close up any show without hearing from our chief strategist, Jeff Snyder, who talks about the recent 2-year Treasury auction in his daily note. And he goes on to say that the Treasury Department sold $45 billion in 2-year notes today. The auction received a better than $116 billion in bids, a slight increase in the bid to cover ratio. He goes on to note that 2-year notes are the most heavily influenced by perceptions of future money rates, including those which might be offered by the Federal Reserve. And most times under normal conditions, these twos would trade in both primary and secondary markets where the Fed's intentions point. Says the heavy demand for these notes at auction day might suggest, along with the heavy curve inversion, perceptions about the rate environment are further shifting away from rate hikes. He ends up closing out his brief on this with less supply in the absence of greater dealer reuse. The latter, the key factor in the current deflationary collateral shortfall, leads to higher potential for systemic liquidity breakdowns, ultimately leading to more demand for treasuries of every type and every maturity. And so, as you can see, not only is China's banking system on the verge of collapse, but investors are looking at the safety of U.S. Treasury securities, telling us once again that the likely probability that rates are going to rise is very low, and that rates, like China's banking system, are too going to come crashing down. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.